It's a Minimalist Monday edition of Optimal Finance Daily, episode 1529. Invest It and Mostly Forget It by Starks of SimpleMoneyPro.com. And happy Monday to you. I'm your host and personal finance enthusiast, Diana Merriam. This is the show where I narrate posts from thought leaders in personal finance every single day of the year in 10 minutes or less. But for now, let's get right to today's post as we optimize your life. Invest It and Mostly Forget It by Dawn Starks of SimpleMoneyPro.com. When we're fortunate enough to experience an extra long period of good times in the market, this can cause two reactions in people. People who have invested for some time and have some understanding of the markets start to get a little nervous. People who have been reticent to start investing begin feeling like they're missing out. This FOMO, or fear of missing out, causes them to jump in with both feet, and invariably they freak out at the first market downturn. So what is a good investor to do? Invest it and forget it. At least mostly forget it. If you're investing regularly now, whether in your company retirement plan or elsewhere, carry on. We cannot time the market. Instead, make sure you have diversification in your portfolio and make sure that you have addressed your risk tolerance. Let me elaborate. If you are the sort who watches the market movements with fear and trepidation, it's likely you don't have much risk tolerance. If, however, you can move along with your life while your investments do their work, and if you don't fret market downturns, you probably have decent risk tolerance. Measuring your risk tolerance can be a bit more scientific, including online investment websites with analytical risk tolerance quizzes. But in my opinion, determining risk tolerance is more of an art than a science. The level of risk you choose for your portfolio should be based on goals and your timeline. The farther you are from the goal, the riskier you can afford to be with your investments. If you're parking money for a shorter term goal, such as buying a home in a few years, your portfolio should reflect much less risk in your investment selection. However, layered on top of time and goals is the art part, the gut part. Know thyself. If you freak out about market movements, make your portfolio less risky, even if you have a 30-year time horizon for your portfolio. There is plenty of evidence out there proving that investors screw themselves over because they dismantle a perfectly good portfolio at the first sign of market downturns. And by doing so, they lock in the exact opposite phenomenon of successful investors. Instead of buying low and selling high, a freak out or knee-jerk reaction causes you to sell low, and then when you see the market improving, you buy back high. This is the main reason financial advisors are so important to clients. We talk them off the cliff before they jump. We protect you from yourself because we understand that markets go up and down. Thus, it's best to invest it and forget it. The more you worry over it and watch it move every day, the more anxious and stressed you will become. If you have a rock-solid gut, in other words, an excellent risk tolerance, and you enjoy watching the market gyrations, then bully for you, have at it. Again, know thyself. If it makes you nervous, stop watching it. A caveat here, I said mostly forget it. This is because after you establish your risk tolerance and choose an appropriate diversification, also known as asset allocation, you should periodically rebalance your allocation. For example, if you decide that having 50% of your portfolio in stock investments is all you can handle risk-wise, and the other 50% is invested in more conservative bond and cash investments, you will want to adjust it after the stock market has an awesome year. If, let's say, the market goes crazy up and now your portfolio sits at 60% stocks and 40% bonds and cash, you would sell off 10% of your stock investments and purchase more on the other side to get yourself back to 50-50. For rebalancing, it's best to be totally clinical about it. Don't let emotions drive your behavior or you will screw up. If you decide that every September or January or June, the month doesn't matter, you will rebalance, then do it. Just because you look and your account is doing completely fantastical things due to the market, so maybe just this once you'll let it ride for a few more months, don't do it. Decide in advance when you'll rebalance and then do it. There's an old Wall Street saying that I don't particularly like, but it's this: Bulls make money, bears make money, pigs get slaughtered. The point is that greed will get you killed in the market. Therefore, rebalance your portfolio regularly regardless of what's going on in the market. And don't freak out and sell it all when the market tanks. Markets go up and down. Remember that, and then go pay attention to something else. You just listened to the post titled Invest It and Mostly Forget It by Dawn Starks of SimpleMoneyPro.com. If you're a small business owner, this is for you. Running a business is just plain hard. Endless to-do lists, employees to take care of, and your ever-present bottom line. So first of all, kudos to you for staying on top of it. But I want to tell you about Gusto. Gusto built an easier and more affordable way to manage payroll, benefits, and more. They help over 100,000 businesses with tasks like automated payroll tax filing, simple direct deposits, free health insurance administration, 401ks, onboarding tools, you name it, Gusto made it easy. 94% of customers say Gusto streamlines payroll and benefits, and we agree here on the Optimal Living Daily team. We use Gusto for our payroll. Plus, they really care about the small business owners they work with. Their support team is attentive and helpful. Since money can be tight right now, you'll get 3 months free once you run your first payroll. Just go to gusto.com/OFD and start setting up your business today. You'll see what I mean when I say easy. Again, that's 3 months of free payroll at gusto.com/OFD. gusto.com/OFD. This article reminded me of a question I received recently from a listener who's new to investing. They were wondering if they should wait for a market downturn to start investing. I think it's important to remember that you'll almost never win by trying to time the market, and that time in the market is much more effective for building wealth. The strategy of investing regularly, regardless of what the market's doing, is known as dollar cost averaging, and it reduces the impact of volatility on the overall purchase of your investments. This strategy removes much of the detailed work of attempting to time the market in order to make purchases of equities at the best prices. A great example of this strategy at work is with a 401k. You're making regular contributions from every paycheck regardless of what the market's doing. Dollar cost averaging guarantees a mathematically favorable average price for your investment because you're buying at both the highs and the lows. It also pairs well with a long-term passive investment strategy. It truly allows you to invest it and forget it. And there are lots of calculators online that you can use to compare this strategy against lump sum investing. Because I'm young, I've also opted for a 100% stock allocation, which allows me to be even more passive about my investments because I don't have to rebalance my portfolio every year. I also don't think all that much about my risk tolerance because passive investing with a 100% stock allocation and a long time horizon allows me to ignore the volatility. Furthermore, a strong cash position makes me even more tolerant of volatility in my portfolio. Because I have cash on hand for immediate needs, it's unlikely I'll need to tap into my investments for unexpected expenses. And that's a wrap for another Monday show. Have a great rest of your day and start to your week. And I'll be back tomorrow as usual, where your optimal life awaits.